These are 5 beginner mistakes that will kill your cryptocurrency profits. That's coming right up. What's going on, everyone? Welcome to the Coin Rocket YouTube channel, where we are now boarding for one-way trips to the moon. So if you'd like to join us, go ahead, hit that subscribe button, and we'll see you there. So today we're going to go over 5 newbie mistakes that'll kill your cryptocurrency profits. Basically, these are mistakes that beginners and newbies make, and we're going to go over what they are and how not to make them. So let's jump right in. So the first mistake is FOMO buying. Okay, buying into hype. Okay, this is really important to look out for because there's a lot of things in this unregulated market that you need to watch out for. So first off, there are shills. Okay, this is people like John McAfee who will post sponsored tweets without telling people that they're sponsored tweets and pump coins that may or may not really deserve it and then dump them. Okay, so whether Verge was a pump and dump or not, it's really not clear because any coin can be pumped and dumped, and who knows what's going to come out of the Verge team in the future. But Verge was one of the biggest pumps and then subsequent dumps in the history of crypto, and that's because John McAfee shilled the coin so hard. And you don't want to find yourself at the bottom of the dump. Okay, so don't buy into the hype. Don't jump in when a coin is up 80% in a day, okay? Because it's really unlikely that it's going to keep going up. I mean, you want to buy when it's cheap, not when it's expensive, okay? There's also cash grabs, which are, I call them shell ICOs. Basically, these are all the ICOs that come out that don't really have a product. They hardly even have a real team, and they probably don't even plan on actually releasing any product. They just want to raise a bunch of money and then run out the back door. Okay, you have to look out for these. You have to do your own research. Okay, and there's also a lot of scams, right? There's Ponzi schemes, pyramid schemes, MLM schemes, HYPs, you name it. Okay, these are all things to look out for. Well, they're common, but it depends on where you look. Okay, so at the top of CoinMarketCap, none of the coins are scams. Okay, Ripple's not a scam, Bitcoin's not a scam, Ethereum, none of them, Litecoin, they're not scams. Okay, but certain programs, okay, like BitConnect and some of the other ones that I won't name because I don't want to give them any publicity. They're scams. Okay, they're Ponzi schemes, pyramid schemes, and first of all, people are throwing around the word scam all the time. If you don't even know what a pyramid scheme is, you shouldn't be throwing that word around. Okay, so pyramid schemes are like MLMs. They're schemes where you have to refer other people to make profit, or they guarantee daily profits, like HYIPs, where they guarantee a certain percentage of returns every day as long as you give them a large sum of money to hold on to. Okay, these are all things to look out for, and you really shouldn't be putting your money into these things unless you really want to and you fully understand all of the risks involved. Next up is FUD selling. Okay, FUD stands for fear, uncertainty, and doubt. Alright, you don't want to sell when the market's down. You want to buy when the market's down. Okay, buy the dip, buy when it's cheap. Okay, I mean, if Lamborghinis were on sale for $1,000 each, okay, you would want to buy when it's cheap, not when they're at $1 million. Okay, it's the same thing with anything else. You don't want to buy when it's more expensive. Okay, you want to buy when it's cheap. Buy when everyone else is selling, sell when everyone else is buying, and that's how you'll make profits. Okay, and just be patient. Okay, you have to hold your coins. I mean, in this market, it moves so fast. Even if the whole market is going down, your coin is, your favorite coins are down, whatever, 30%, 50% even. Just be patient. They're gonna go back up in probably a few days, at the longest a few months. Okay, so just hodl for the long term. And it's important that you hold these coins and don't sell at a loss, because if you sell at a loss, you're just losing money. You're just choosing to lose money. Okay, Remember, you don't lose unless you sell. Okay, so just only sell whenever you're in profit. That's it. Only sell if you've made a profit. Otherwise, you're holding. Okay, this next mistake is day trading as a beginner. So as a beginner, you really don't want to be doing too much day trading because it's not as easy to make profits as people think. Okay, most people don't even actually make profits because they don't even know how to. Okay, they buy into hype, they sell during the FUD, okay, and they're not even outperforming people who are just holding onto their coins. Here's the thing, it's really hard to time the market, and the market is going up so fast. The market is rising so quickly that you really have to be a really good day trader in order to outperform the market. Bitcoin went up over 1,000% in 2017. Say you do make over 1,000%, then you're just equal with Bitcoin, right? All that effort and all you've done is got yourself in the same place as someone who just left Bitcoin in a wallet and did nothing about it. They could have forgotten about it for a year, okay? And here you are spending all your time day trading. It's really difficult to outperform the market. So you should avoid day trading unless you're really good at it, unless you're experienced, unless you're seeing a lot of returns. And when you see good returns, you have to calculate your profits in cryptocurrency, not in USD. US dollars go down in value. So obviously, you know, any cryptocurrency you have, if you're trading, it's going to go up in USD value because the US dollar loses value every year and the entire market's going up. So no matter what trades you make, right? If you're just looking in USD value, obviously it's going to go up. So don't think you're a good trader just because your trades are going up in USD value. You have to make sure your trades are going up in Bitcoin value, in Satoshi value, okay? So if you bought whichever altcoin with however many Satoshis, right, of Bitcoin, you have to make sure that when you sell it, you're not just selling it at a higher dollar value, but you're selling it for more Satoshis, more Bitcoin than you paid for it. Otherwise, you're not even making a profit. You're making a loss, and you're just paying attention to the US dollar value, which is always going to go up basically no matter what. And next up is not diversifying. So diversifying is a mathematically guaranteed way to reduce volatility. Okay, volatility is basically the amount that your holdings can vary day to day in price. So basically in cryptocurrency, I think the average is that coins can go up or down like 20 something percent. So the volatility is about 45%. And when you diversify, what you're doing is you're limiting the risk of that happening. So if you only own 1 or 2 coins and those coins go down, then your entire portfolio just went down. But if you own 10 or more coins, it's less likely that all of those coins are going to go down. Okay, so basically the entire market on average is going up. Okay, the entire market actually outperformed Bitcoin last year. Okay, Bitcoin went up over 1,000%, but the entire market went up over 2,200%. So if you're limiting yourself to just a few coins, then what you're doing is you're just taking on unnecessary risk. Okay, the more coins you have, the more likely it is that your overall portfolio average is going to go up in value. Okay, but what you don't want to do is spread yourself too thin. So you don't want to just put like $1 or a few dollars into like 1,000 different coins or 100 different coins. Okay, you need to diversify depending on how much you can afford. Okay, so my rule is that I don't put less than like $50 to $100 in each coin, and that's about what I can afford. So you know, if you've got like $1,000, you just can't afford to split that 100 different ways, okay, and put $10 in each coin, because for starters, your holdings are just going to get eaten up by fees. Okay, and another point is that if you only have $10 in each coin, okay, and that coin, even if it has like a really good run up, you're not even going to make a big profit off of that because you only have $10 invested, right? So you don't want to spread yourself too thin, right? It's a fine balance. But diversification is important because if you have all of your eggs in 1 or 2 baskets, then you're really taking on a lot more risk than if you had diversified into maybe 5 or 10 or more, depending on, again, how much you can afford. And you can diversify not just into different currencies, you can diversify into programs, into like cloud mining, for example, into regular mining, right? Like a mining rig or a mining pool, your own mining setup, I mean, or you can invest into, proof of stake coins, or there's all kinds of different methods to diversifying. And this channel is about cryptocurrency, but diversification isn't just limited to cryptocurrency either. I mean, there's stocks and bonds and real estate, and if you can afford to diversify that much, really what you should be doing is diversifying at different levels of risk. Okay, so for example, stocks, bonds, and real estate are lower risk than cryptocurrency, and ICOs are like super high risk compared to just like coins, like established coins like Bitcoin and Ethereum. What you want to do generally is put most of your holdings into the lower risk options, okay? Or what you can do is you can start with a lot of your holdings in the higher risk options, and then as you gain profits, move your profits into the lower risk positions. And last is just not doing your own research. So don't take anyone's word as 100% truth, okay? People trust John McAfee just because he was part of McAfee antivirus, I think. I mean, whatever, the guy might know something about programming antiviruses, but nobody, okay, has a crystal ball. Nobody. All people have is experience, and that experience is only limited to as long as they've been crypto trading, which for a vast majority of people is not that long. And for everyone, really, is not that long, because the entire market hasn't been around that long, right? I mean, Bitcoin isn't even 10 years old yet. Okay, so even the oldest veterans in the industry don't have that much experience, okay? So you can't trust anyone with 100% certainty, okay? So just ask yourself, are my sources reliable? And you shouldn't, even if they are reliable, okay, you can't just take their word for it and then blindly follow whatever they say, okay? That's how you end up buying into a pump and dump scheme, like when John McAfee was pumping Verge, okay? Don't just take people's word for it, okay? And that includes me. Don't just blindly follow what I say or anybody else. And you have to ask yourself, right, is this project legitimate or is it a scam, right? So don't just, look at the coin and then, look at whatever, like the logo and the price, okay? So price doesn't matter, okay? Supply doesn't matter, okay? Those two things don't matter. These are kind of like a little bonus tip that I'm going to give. So price and supply do not matter. What matters is market cap, okay? If someone says a coin is cheap and they're referring to the price of the coin, they have no idea what they're talking about, okay? If you have two objects that are worth $50 each and 50 objects that are worth $2 each, those are both worth the same, okay? One isn't cheaper than the other, okay? They're worth the same amount, okay? So you have to look at the market cap, okay? The market cap is the price and the supply, okay? Because prices depend on how many of something there is, okay? So if there's a trillion of something in the world, okay, then just having one of them is not a big deal. So it doesn't matter if it only costs a few cents, because there's trillions of them. They're so easy to come by. They're not scarce, okay? They're not rare. There's no rarity to them, or there's a really small amount of scarcity to them, okay? They're easy to come by. They're common, right? Whereas on the opposite end of the spectrum, if there's only like 10 or 100 of something in the entire world, right? Like rare baseball cards, or whatever collectibles, like cars or whatever, right? Those things, right? They have higher prices because they're more scarce, because there's not as many of them in the world, okay? But when you're looking at a cryptocurrency though, if you're just looking at the price, you're only looking at one part of the equation, right? The part of the equation that doesn't really give you enough information to base your decision, okay? So what you should be looking at is the market cap, and that's why when you go to coinmarketcap.com, they're not listed by price, they're not listed by supply, they're listed by market cap size. What you want to look at when you're doing your own research are fundamentals and the technicals. So technical analysis is like when you're reading charts, when you're looking at the price action, okay? And fundamental analysis is looking at the actual project itself. So looking at the currency, what utility it has, you know, why people would use the coin, the team behind it, right? So the developers that are creating the coin, and maybe the marketing behind it, and maybe, you know, their roadmap, and all the different fundamentals that give the coin an inherent value, okay? So some people strictly go by fundamental analysis, some people strictly go by technical analysis. Personally, I like to use both because it's really not clear which one is the ultimate answer to, you know, finding undervalued coins. So I would recommend looking at both the fundamental and the technical analysis. Now, technical analysis is kind of difficult to do. It has a bit of a learning curve. If you don't understand reading charts, right? I mean, it's really, especially in the crypto market, there's really not even enough evidence to support the claim that technical analysis is really even useful in predicting price action of coins. Fundamental analysis, on the other hand, is going to give coins an inherent value, right? So, for example, if we look at Verge, right? Verge's chart was pretty much flat until John McAfee was shilling it out, and then the price skyrocketed, and then it had a huge dump. Well, if you're reading the technical analysis, you know, I mean, there's no technical analysis you could have done on Verge that would have predicted that. And really, there's not even a fundamental analysis that would have predicted that, except for the dump. Okay, so with fundamental analysis, you could have predicted the dump, because the reason that Verge went back down as much as it went up is because the value, the fundamentals hadn't changed. There was no value added to the Verge project when Sean McAfee shilled it out. There were just more people buying it. That doesn't add value, that just increases the price in an unsustainable way. So the price is just gonna go back down as much as it went up. You have to do your own research. So this kind of ties into everything else I've been saying in this video, right? You don't want to trust anyone else 100%. You want to buy based on facts and your own decision rather than someone else's authority or, you know, some hype. Those are my tips. Those are some mistakes that you should stop making if you're a beginner. Hopefully you found some value in this video. Thank you guys for watching. Remember to leave a like, a comment, a subscription. Go ahead and share it if you want. And I'll see you guys next time.